Net unrealized appreciation. I'm going to go over that in today's video. In fact, I'm going to go over it right now. I have a lot of other videos that are longer about early retirement, about tax planning and investment planning. And if that's what you're interested in, welcome to the channel. If you're just looking for net unrealized appreciation answer, here you go. Quick reminder, once again, I am Taublieb. I am a financial advisor and I help people retire early. Host of the Early Retirement Podcast, as well as vice president here at Root Financial Partners. I'm going to show you exactly how net unrealized appreciation works and how you can use it to your benefit. So let's assume that you've been working for many, many years, and I'm just going to use an example here in that you've been working at Apple. So you have Apple stock in this example, and let's assume you bought it for $50,000. Now, let's assume that's what you bought it for, but it's now grown and now it's worth $500,000. So you have $500,000 in Apple stock, and you have another $500,000, and I'm just going to say that's in a diversified portfolio of mutual funds. So once again, to summarize real quick, $50,000 you put into Apple stock. It grew by $450,000. So now you have $500,000 total in Apple stock, of which case $50,000 is what we call your cost basis. That's what you purchased for it. And then over here, you have $500,000 of just mutual funds. So now you're wondering, okay, I'm retired. Already maybe I heard a different video of yours or just something online showing I can do what's known as a rollover, where you move funds from your 401k, which you can do, by the way, once you retire, or sometimes it's immediately when you leave, a previous company, if you don't roll it into a new company, but also at age 59 and a half. This is what's known as an in-service rollover or an in-service distribution, which a lot of people do not know about. So pretend that you're 55 and you've been working, and now you're 60 and you're like, well, I'm not gonna retire till 63. You can actually do this in-service distribution, move these assets from your 401k to an IRA or brokerage account. So that's just a side note, but let's talk about this NUA again. Once again, you now know you have these two moving pieces here. You have diversified mutual funds, and then you also have Apple stock with that cost basis. You're wondering, what should I do? Well, here's the benefit of net unrealized appreciation and why people talk about it so much. If you were to not do what I'm going to say, here's what would happen, okay? You could not do net unrealized appreciation, and you could move all of that Apple stock into an IRA. So it's going to all grow tax deferred. When you pull it out, you pay taxes on it. So when you pay taxes on it, you are paying what's known as ordinary income tax. You're paying taxes based off of the income that you have that year. Maybe you have Social Security at that point. Maybe there's pension. Maybe there's other income that you've gone back to work. And so at that point, you're subjecting yourselves to ordinary income. What's more attractive than ordinary income is what's known as long-term capital gain. So you could be paying, most cases, 15% is where people kind of fall, and it depends on certain brackets, but it's either 0%, 15%, 20%, and then sometimes there's this little extra tax on there of 3.8. But don't worry about that for today. Here's what you need to think about, high level. You now have this Apple stock position, and you're going, okay, should I move that to an IRA? And I've got these other mutual funds. Trust me, I'll get to that. But you've got this Apple position. So let's look at it one by one, if you will. Let's look at the Apple position first. You have a $50,000 cost basis. So if you were to move all of this to your IRA, it would essentially make that disappear. It's just saying, hey, you're issuing a check of $500,000. They don't care what you bought it for. If you bought it for $499, it grew by $1,000. It's all going to an IRA, and that IRA you can then invest however you want. And then as you pull income, you pay ordinary income tax on it. Now, I would rather see you do net unrealized appreciation in this example more often than not, and here's why. As opposed to paying ordinary income tax as you withdraw all $500,000, what you could do is say, I want to do net unrealized appreciation, where what you do is you intentionally pay ordinary income tax, but only on the cost basis. So only on the $50,000 that you originally paid for Apple stock. Stick with me here, if you will. I know it can get a lot, but just stick with me. I think it'll resonate. $50,000, if you will, that's the Apple stock position that you bought. Now that $450,000 of growth, we do not want that to go to an IRA, because IRA, ordinary income tax, we want that to go to a brokerage account. That brokerage account, that is going to be taxed at long-term capital gains rates. So you are going to be paying less tax on those gains. So you're looking at this going, okay, what's the difference there? Well, let's assume you're in a really healthy tax bracket. Let's assume you need income and you don't do what I just said. Well, now you're going to have ordinary income tax from your IRA, and you could be paying 30, 40% taxes on that. I would rather have that not be the case and have you pay long-term capital gains rates, which oftentimes can be half of the amount of tax, which can be a huge benefit to you from this gain of this amazing position that you've worked hard for to accumulate. So that's where net unrealized appreciation does make sense. It's saying, can we pay ordinary income tax on what we bought it for, the cost basis, and then everything above that is long-term capital gains. So that's an example of that. Now let's assume, take that example, 50,000, 450, move it all to a brokerage account, not an IRA, a brokerage account, which has no special tax benefits, but it allows you to do this net unrealized appreciation. Now let's assume that 500 grows and grows and grows, and let's assume it grows to 700,000, and that happens under a year. Well, now you're paying short-term capital gains rates, but only on that 500 to 700 growth of 200,000. So just wanted to be clear on that. Now, let's take it a step further. You've got these diversified mutual funds. So now you're wondering, okay, Ari, what on earth do I do that with that? Well, you just explained was barely English, so I promise I'm going to keep it simple for you. These mutual funds, with these, you do not want to move those into a brokerage account, because what would be happening is you'd be paying ordinary income tax on that whole amount. So we don't want to do that. What you want to do instead is you want to say, okay, how can I make sure I'm deferring income in the most efficient way possible? So these mutual funds that you've worked hard to accumulate, we want to move that to an IRA. There's no tax impact today. Then as you draw income little by little over time to meet your living expenses, or maybe you don't need to draw income, it just keeps growing tax deferred. You don't pay taxes on dividends or capital gains as those accrue. Let's assume you have an Apple position, it grows. Great. If you choose to sell that and move it to another position, you don't pay taxes on that if it's in that IRA. If it's not, we do pay taxes. So this is all to say, if you have, company stock and it's done a really, really good job, it's appreciated to an extreme degree, and you're in a relatively low tax bracket, NUA, net unrealized appreciation, may very well make sense. If that's not the case, and you also have mutual funds, or you have kind of like two different things going on here, that's when I'm gonna say, hey, it doesn't make sense to do a portion with NUA, a portion non-NUA, just traditional rollover. So just wanted to summarize that. I've had a lot of clients ask me that question, so I wanted to make this quick video on it. Once again, if you're wondering how this impacts your overall financial plan, this of course is what I do. I help people retire early. I am the host of the Early Retirement Podcast and want you to know that I'm the vice president of Root Financial Partners as well. So if you're looking to meet with a member of my team and work with us, please, you can see the link in the description. Click that and fill that out, and we'll talk to you soon.